It's a great pleasure for us to be with you. I'm Bobby Coates, a professor in the Department of Agricultural Economics and Agribusiness in the University of Arkansas Systems Division of Agriculture. Now joining us is Dr. Pat Westhoff to discuss the market outlook under the new or 2018 Farm Bill. Pat is Director of Missouri FAPRI, Food and Agricultural Policy Research Institute at the University of Missouri-Columbia, and a Howard Cowden Professor in the Department of Agricultural and Applied Economics. The mission of FAPRI is to provide objective analysis of markets and policies. Dr. Westhoff and the FAPRI group are part of a very small, highly specialized, and elite set of analysts who command the respect of members of Congress and their staffs, and anyone focused on commodity markets, economic outlook, and agricultural policies. Now, Dr. Pat Westhoff, on the market outlook under the new Farm Bill. Pat, we look forward to your presentation.
Thanks a lot, Bobby, for the opportunity. Thank you, Mary, and everybody else who got this arranged today. I very much appreciate this chance to talk to you today about things we know and things we don't know. The list of things that we don't know may be just as long as the list of things that we know today, so we'll see how we do. So let's proceed and talk a bit about the market outlook under the new Farm Bill. So one thing I want to talk about up front is going to be what's missing, things that we would normally know by now that we don't know, part because of the government shutdown and part because of our ongoing trade disputes. I'll talk a bit about the new Farm Bill and how it might affect people in the crop sector. Talk briefly about the macroeconomic environment and how that may impact markets. And then dig into the crop markets in general, talking about corn, soybeans, wheat, cotton, and rice. The normal supply and demand factors we talk about anytime we do an outlook discussion, but then focusing particularly on the trade issues that make things particularly uncertain at this time. So as a reminder, markets are always uncertain. I'm not saying you don't already know, of course. We never have perfect information. We don't know what the weather's going to do. We don't know how the general economy is going to evolve. And of course, there's a long list of things I could tell you that are going to make the markets uncertain any given day of the week. It's always good to have good excuses about why our numbers aren't going to be right. But I have even more uncertainty than we normally would talk about today around those market projections. So what's always going to be uncertain, of course, is going to be the weather and things like that. We try to capture them what we call our stochastic analysis. So instead of just doing one single best guess about what the future might look like, we actually take our models of the farm economy and solve them about 500 times so we can generate not just a point estimate, a single estimate, but rather a distribution of things like prices and the like. So instead of saying, the price will be such and such, we can say, well, we think there's a pretty good chance to be in this following range. What are some of the probabilities associated with that? So to give you a concrete example of that, one that's not too embarrassing to put on the screen even today, here are some numbers we did a year ago at this time, looking at the corn market and giving you the U.S. marketing year average price for corn as reported by USDA. So you see the years of history there through 2016. Well, we thought the 2017-18 marketing year price might prove to be a year ago, which proved to be close to where we ended up. I think like about a dime of where we ended up for the season average price for last marketing year. And then our projections for the future. So the green line in the middle there would be kind of close to what we would say if we were just doing a single best guess about what the future might hold. It's actually, though, the average of 500 outcomes that we look at. Blue line on the top there is going to be what the 90% of those outcomes are. That means that 10% of the time when we solve our models, we get a price higher than the blue line. And 10% of the time we get a price lower than the red line. So for the 2018-19 marketing year, that turns out the midpoint of that price range was about 357 or so. The 90th percentile is in the 440 or so range, and the 10th percentile is around 280 or so. Quite amazingly, that price range we talked about a year ago seems pretty reasonable even today. Hopefully we think we've narrowed down the uncertainty over the current year a bit, but the average estimate is actually not too far from where we appear to be today. That's more luck than anything else because lots of things have happened over the past year. But just a reminder that there's a lot of uncertainty in front of us. Note, of course, that even though we have a lot of uncertainty, we think the chance of a price above $5 a bushel in the moderate, the medium-term outlook is not terribly high, nor is the chance of a price below about 280, 290 or so per bushel very high. Things can happen. We could have a repeat of the sort of circumstances that caused us to have extraordinarily high prices between 2010 and 2012, but it's really not the most likely outcome. So what are some reasons that the markets are even more uncertain than usual right now? One would be the trade issues. Will existing tariffs and other trade restrictions still be enforced 3 months from now, a year from now? We don't know. Will the US-Mexico-Canada agreement finally be approved by Congress? Or will there be some more disruptions there before we're all done with that process? Will there be new agreements or disputes with China and other major trading companies? We've identified the start of March as a time where the president says we want to try to get to an agreement. You know, is that actually going to happen? If there is an agreement, what will it look like? If there's not an agreement, what happens instead? So that's one set of issues we'll talk about a fair amount today. And the other one I'll just talk about briefly right now is about all the information we don't have because of the government shutdown. Weekly export reports, would normally be coming out that we don't have. So how many soybeans did China actually buy recently? We don't know. What was the final numbers for 2018 corn crop production? You know, how big was last year's corn crop, for example? You know, even if those previous estimates that are in the marketplace are relatively close, it's almost inevitable that when USDA does finally issue their final estimates for the 2018 crop, there'll be a few surprises. And if those move the markets even by a few cents a bushel, you know, it can be a big difference in how we look at the future. December 1 grain stocks, just how large are carryovers in general likely to be across the board with soybeans in particular? Are we looking at something like, you know, nearly 1 billion bushels of soybeans on hand at the end of the market year? Is that the pace we appear to be on or not? Winter wheat seedings, you know, how did the weather problems we had last fall translate into wheat acreage? Will people actually get as much wheat in the ground as they wanted to? You know, looks like probably not, but just where do we end up? We don't know right now. And then finally, kind of a small point, you know, when you're computing the marketing year average price for products like, say, rice, for example, that will be used to determine PLC payments, it's very helpful to look at the monthly prices that USDA puts out. And those aren't always easy to guess just looking at where, you know, cash markets or futures markets might be, because they take into account not just what the cash price might be, but also what people might have forward contracted months ago. So right now, all we have are prices through the month of October. We don't have November prices yet, even though we normally have gotten those a few weeks ago. And shortly we will be missing the December prices we would have at the end of this month as well. So again, there's even more uncertainty about just some basic facts of life than we would normally have. So I want to switch now and talk a bit about the Ag Improvement Act of 2018, the new Farm Bill. I'd start off by saying it's an evolutionary bill, not a revolutionary bill. If you like the previous Farm Bill, you probably like this one. If you didn't like the previous Farm Bill, you probably don't like this one. The Agricultural Risk Coverage Program, the Price Loss Coverage Program are continued in a form relatively similar to what they were in the 2014 Farm Bill. There are some slight modifications, but the basic structure is still the same. There are very few changes to crop insurance, at least for the major field crops. So again, not many changes there in those two major pieces of the ag safety net. There are some changes that are worth noting, and we'll talk about those one by one. We'll talk about the ability for some producers to update their PLC yields to their advantage. There's trend adjustments in determining the benchmark revenues for ARC. That changes the possibility of people getting an ARC payment in a given year. There are multiple opportunities to make new ARC and PLC elections, so those will be important for people to think about here in the months and years to come. We have higher loan rates for many crops, changes in payment limitation rules, a restructuring of the dairy program, and a conservation program restructuring as well. So let's take those one by one. First, talking about the payment yields for the Price Loss Coverage Program. So under the new Farm Bill, producers can update their PLC yields under some circumstances. It will make sense for farmers to do so if the 2013 to 2017 average yield for their farm is far enough above their existing program yield. Just how much it has to be above their program yield depends on what's happened with national level yields for that particular commodity between 2013 and 2017 compared to the average of 2008 to 2012. And so there's a table there showing at least our rough estimates of what those percentages will be. So that if your average yield for the last, for the 2013 to 2017 period, I should say, is sufficiently above the payment yield that you have today, it'll be worthwhile updating. In the case of corn, it's 81% is the magic number. So if you take your 2013 to 2017 average, multiply that by 81%, and the result is greater than your current payment yield for PLC, it's probably going to be in your interest to update that yield when you have the chance to do so. Percentage is different across crops given the way the formulas are set up by the Farm Bill. Again, I want to emphasize those are estimates. They aren't going to be the official numbers that will come out from FSA when the time comes. Where this might matter, again, I want to emphasize these are guesses right now based on our interpretation of the Farm Bill and looking at some county level data. but it appears to us that the counties in blue and red on this map are the counties that are it's most likely that farmers will benefit from updating their yields. Doesn't mean every farmer in those counties will, or that no farmers in the counties in white will benefit, but does mean that the probabilities are probably higher in the counties in blue. So you can see in the case of Arkansas, for example, there's probably not many counties in Arkansas where an update will make sense in the case of corn. Whereas in my home state here of Missouri, we have quite a few counties where an update will probably make sense. In short, this is because between 2008 and 2012, we had extraordinarily low average prices for corn in the state. We had a very high average price between 2013 and 2017. So here in Missouri, an update will probably make sense for quite a few producers. You can see in the northern corn belt, if you take a stretch from Ohio to Nebraska, north of I-80 roughly, there's not many counties in those states that are going to be able to benefit from the yield update. In the case of soybeans, the map is a little bit different, but has some similarities as well. I see a handful of counties here in Arkansas do pop up in blue. Less counties in Missouri on the other hand, and you can see the way it spreads across the rest of the country. Again, just emphasizing this is a rough guess on our part at this point. You'll want to watch to see what the final FSA rules say, and check in with your office when the time comes to make sure whether an update makes sense for you if you're a producer. Lots of other ARC and PLC issues as well. In the case of ARC, in determining the benchmark that's used to determine whether someone is eligible for a payment in a given year, instead of using the average of the last 5 years, throwing out the high and throwing out the low only, there'll be the opportunity to use a trend adjusted yield, which will take that 5-year average and adjust it up, much in the way that crop insurance yields can be adjusted up if people choose to trend adjusted policies. So that'll make it a little bit more likely that the benchmark will be higher than the actual revenue in a given year, increase the probability of an ARC payment by at least a small amount. Likewise, if there's a very low yield in your county in a given year during the benchmark period, instead of using the observed very, very low yield, the formula now will use 80% of the transitional yield instead of a lower level that was used in the 2014 Farm Bill. So both of those changes will make it more likely that an ARC payment might occur in any given year. In terms of ARC and PLC elections, producers will have the opportunity to make a new election for the 2019 and 20 crop year. So one decision that will cover both of those crop years. When that will happen, we don't know at this time yet. Of course, depend on when the government shutdown ends and when offices are up and running full bore, and people in DC are able to, make all the policy choices they have to make for getting things running. But you expect sometime this year, you're going to have a chance to make a new election for the 2019 and 20 crop years. And then you'll have the chance to revise those elections in 2021, 2022, and 2023. So for the 5 years of this farm bill, there'll be 4 different elections you can make if you choose to. Given what we know today, which of course could change, we would expect heavier PLC participation in 2019 than in previous years, especially for corn and for wheat. For corn and soybeans under the 2014 Farm Bill, the vast majority of production is enrolled in the ARC program. Given what's happened to the ARC levels of guarantees and where we think prices might be going in front of us, especially in the case of corn and wheat, it appears to us at least that PLC may be the more attractive option for more producers this time than was the case in 2014. We plan to work with our colleagues at Texas A&M and at other universities to provide tools that can be used for producers in making those choices, much as we did in the 2014 Farm Bill debate. Loan rates. Loan rates have been increased for several commodities, different percentage increases for different commodities. You see the numbers here on the screen. Corn goes from $1.95 per bushel for the 2018 crop year to $2.20 a bushel for 2019 and beyond under the new Farm Bill. Soybeans from $5 a bushel to $6.20. Wheat from $2.94 per bushel to $3.38. Sorghum from $1.95. Rice $6.50 to $7. The same formula applies to cotton as applies today, except that the decline from one year to the next can never be more than 2%. So you wouldn't have as many downward adjustments in a hurry on cotton as you've had under the 2014 Farm Bill possibilities. These are all new loan rates are below what we expect market prices to be. So we don't expect loan deficiency payments to be common under the new Farm Bill for these commodities, but it does improve the ability of farmers to use this program as a marketing tool. You can take out a loan now at a higher rate at the fall after harvest and repay that later, of course, as a marketing tool to give you some cash flow at harvest time you otherwise wouldn't have. Some other Farm Bill provisions. There are some important changes in payment limitation rules. For example, nieces, nephews, and first cousins are more likely to qualify as actively engaged in the farm and therefore eligible for payments. But I want to stress that I'm an economist, not a lawyer. My wife, the attorney, reminds me of this constantly. And so I'm not an expert on the issue, and I don't want to really try to give you any further details on that. You should just wait to see what the regulations say and talk to an attorney who can advise you on those matters. Dairy program provisions are very important. I'm not going to talk about those much today, but if you're a dairy producer, you definitely want to pay attention to the changes that have been made in the Farm Bill. The biggest change is that for the first 5 million pounds of production on a farm, the premiums that someone would have to pay to be able to protect against even a relatively high margin between milk prices and feed cost, those premiums would be quite a bit lower than they were in the previous Farm Bill, and you can ensure a higher level of coverage than was available before. So again, dairy farmers should definitely take a look at the new provisions and make sure they make the choice that's best for them. Then the conservation side, several changes. One is that the cap on CRP acreage is increased from the current 24 million acres over time to 27 million acres by 2023. So more acres can be enrolled. However, if you do choose to enroll acreage in the reserve in the future, you'll only be able to qualify for a maximum rental rate of 85% of the county soil type average. If you do it under a general sign-up, 90% of the county average if you do it under a continuous sign-up period. So a lower rental rate than has been allowed under previous regulations. The new Farm Bill does scale back and restructures the Conservation Stewardship Program, making it work more in tandem with the Environmental Quality Incentive Program. More funding is provided for the Agricultural Conservation Easement Program and Regional Conservation Partnership Program, and other programs are changed as well on the conservation side. Now let's talk about the macroeconomic environment a little bit. Real GDP growth has been relatively constant actually for quite a few years now in the United States and for the world as a whole. For the US, we've been somewhere between 1.6% and 2.9% per year every year since 2010, which is a pretty incredible stretch of very, very constant growth. World economic growth likewise has been around 3% every year since 2011. However, if you look at the chart carefully, you'll see that in both 2019 and in 2020, IHS Markit, a private forecasting group we rely on for macroeconomic projections, is showing a slightly slower growth path for the next couple of years than we've experienced here in 2018. So about 2.5% growth in the US market economy in 2019 and about 2% growth in 2020, down from almost 3% growth in 2018. Very important to soybeans and a number of other commodities, of course, what happens in China, as everybody knows. Chinese economic growth has been phenomenal, as fast as 10% economic growth as recently as 2010. That's now slowed down to about 6.5 or so percent in 2018, and expect to slow a bit further in 2019 and 2020. Still very healthy rates of growth by standards of most countries, of course, but not as fast as we have been experiencing for some time. Interest rates and inflation, of course, are of concern and interest to people, of course, as well. The Fed has indeed started to tighten the interest rate environment. We're seeing higher rates across the board. The rate that the Fed most directly controls, the Fed funds rate, averaged a bit less than 2% in 2018. And of course, end of the year higher than that. IHS Markit projects a couple of additional increases in interest rates in 2019 as well. So that by 2020, the annual average federal funds rate is about 3%, and the prime rate increased from about 5% on average last year to over 6% by 2020. So again, a different interest rate environment than we've been used to. Not everybody agrees that we'll see as much tightening as IHS Markit's projecting here. There are, I think the average of the market right now is probably a little lower than what this chart shows. But nevertheless, the chance of a decline in interest rates is certainly not very high right now, unless there's a major disruption in the economy. And then finally, the couple of major deficits we often talk about that could affect the agricultural sector. After shrinking between 2009 and 2015, the federal budget deficit on the red line in this chart has started to increase again, reaching almost $800 billion in fiscal year 2018. And by IHS Markit's projection, reaching about $1 trillion this year. So that's a very different trajectory than a lot of people would like us to be on. It probably makes it more difficult to get approval in Congress for additional ways to spend money, and could even imagine, you could imagine at some point in the future, maybe not this year, maybe not next year, but at some point in the future, there may have to be another significant effort to address the budget deficit. That could have implications for farm programs as well. Then also the current account balance there in the blue line, it's a broader thing than just a trade balance. It includes more things than just the ordinary trade balance does. But just to make the point that even by this relatively broad measure, we're not seeing the type of improvement in our overall trade balance as some people are hoping to see. So that, that's going to be one that people will be watching carefully. The president, of course, has been very much focused on what happens to the trade deficit, and this could end up driving some policy choices in front of us. So giving you that background on both the Farm Bill and on the macroeconomic environment, let's talk now for the next bit about the market outlook for the major crops. Let's talk about soybeans. Soybeans is, for very good reasons, catching a lot of attention and probably deserves it. So let's remind ourselves where we've been. So if I look at the season average prices that the USDA was projecting for soybeans as recently as June of 2018, they're expecting a 2018-19 marketing year, the marketing year we're in right now, to have an average price of soybeans about $10 a bushel. And futures prices were consistent with that. In fact, maybe even a travel higher than that if you looked at where markets were in June of 2018. A $10 price in 2018 would have been the highest price since 2014. But of course, things have changed. So the last numbers we have from USDA for the month of December, we don't have a January set of estimates because of the shutdown, but the December estimates were that we'd end up about $8.60 a bushel was the midpoint of the range projected for 2018-19. So instead of projecting the highest price since 2014, now we're talking about the lowest price since the 2006-2007 marketing year. So it's a pretty dramatic change of direction. If you look where futures markets were earlier this week, looking at the March futures contract for 2019, that's where the first dot is there in the blue line or black line. And then the November contract for 2019 is the second point there on that last line. You see futures market, even when you take into account normal basis, are probably just a little bit stronger than where USDA's projection was in December for the 2018 crop. And again, showed maybe a slight uptick in 2019. So we'll talk about why that might be. So first, about why are prices low? Let's talk about some of the usual suspects first. We've had record yields. Again, we don't know the final numbers yet. We'll see what the final numbers are when they're finally released, when the government reopens. But based on December estimates from USDA, we were looking at the highest ever national average corn yield in the country in 2018, and the highest ever by just a fraction soybean yield as well in 2018. So those high yields, contributed to a different situation than would have been the case with more normal yields. But of course, the big headline thing has been trade disputes. So starting in July, U.S. put in place tariffs on $50 billion of Chinese products in response to China's intellectual property practice and other policies. They retaliated with 25% tariffs on U.S. soybeans and other products valued at $50 billion. Beginning on September 24th, the U.S. imposed 10% tariffs on another $200 billion of imports of Chinese products. And Chinese responded with tariffs on additional $60 billion of U.S. products. So back and forth has happened over a period of time. In the G20 meeting that occurred in December, there was an agreement not to increase tariffs as threatened. So at least things haven't gone farther than that. And indeed, China has agreed to purchase some soybeans since that time. Many people in the market believe it might have been about 5 million tons, but we don't even know that for certain, given the unavailability of data because of the shutdown. But they have, however, maintained the tariff at 25% on U.S. soybeans. So even if they bought some soybeans, they haven't gotten rid of the tariff that was the cause for the sharp slowdown in U.S. sales. We care about this a lot because China has been a very large market for U.S. agricultural products, about $22 billion on average between 2010 and 2017. Soybeans accounted for about $13 billion a year on average of that, about 58% of that total over that period of time. You can see the numbers there for other major crops, and then for pork, dairy products, another a variety of other things that China imports from us. So again, soybeans being the dominant part of the story. China's our #1 export market for soybeans by far in a typical year, and so when they don't buy beans, it's a big deal. So that new tariff, just to talk about it in words before we get into numbers here, has the effect of pushing up prices of U.S. soybeans delivered to final users in China. The tariff, on the other hand, pushes down prices of U.S. soybeans in this market. These changes in U.S. and Chinese domestic soybean prices make it harder for us to sell soybeans into China, makes it easier for Brazil, Argentina, and other countries to make sales to China instead. because of these changes that occur in prices and in all those different players, that probably means that we're going to see prices in other exporting countries that go up. That's going to discourage them from being able to sell products to the European Union, to Japan, and to other markets, and make it easier for us to sell products there. And then if you look at the trade data so far this year, that is very much what we've seen. We've seen the U.S. sell a lot fewer beans to China than we normally would, a lot more beans to other markets than we normally would. But China is just so big that the increases to the other markets aren't enough to offset the large drop in sales to China. And one way to think about is what's happened to the relative prices of U.S. and Brazilian soybeans. These are looking at historical prices for this past year, the 2018 calendar year. The green line is going to be the price at a port in Brazil, Paranagua, one of the major export ports in Brazil. And the red line is going to be the price in central Illinois. If you were comparing a port price in the U.S., a Gulf price, for example, you find that's probably closer to the Paranagua price than, in fact, they're almost on top of each other normally. I didn't happen to have that Gulf port price handy when I was putting the chart together. But look what's happened to that difference between those two prices between the time, or before the time that the tariffs were imposed and after the tariffs were imposed. So before July, before those tariffs were imposed, the average gap between the port price in Brazil and the central Illinois price is about $48 a ton. Since that time, it's averaged about $100 a ton, with the gap between those two prices, narrowing and widening depending on people's views about what might happen about the trade disputes with China. When people get optimistic there'll be a resolution of the trade dispute, as happened during November and probably in subsequent data if we had it available, you'll find that the gap tends to narrow, where we go back to a more normal relationship between U.S. and Brazilian prices. But when people are convinced that we're going to keep those tariffs in place on U.S. soybeans for the longer haul, then the gap widens up again. So the Brazilian prices can have a premium to U.S. prices, given the fact they don't have to pay the tariff when they are sold in the Chinese market. So if you look at what's happened to USDA's estimates for the soybean situation between June and December, first it's important to focus on just the basic normal stuff that would affect markets. We saw a few more acres and a lot higher yield than anticipated in the soybean crop. Relative to June estimates. So the December estimates about 4.6 billion bushel crop. That's 320 million bushels more than had been estimated as recently as June. If you look at the change in stock levels, that was expected to be just 385 million bushels was expected to be the carryout in June. By December, that had been increased to 955 million bushels, an increase of 570 million bushels. So of that increase in stock estimates, about 56% of it can be increased just by the increase in production. So it's important to recall that, just ordinary supply and demand stuff has a big impact on the market. The average price estimate changed by $1.40 during that period of time. So again, a lot of it's just production has increased. But of course, an even larger share of it is the fact that we've probably lost quite a few export sales. December estimates from USDA were for 1.9 billion bushels of soybean exports this year. That was down by 390 million bushels from earlier estimates. So that's 68% of that overall higher stock estimate we just talked about a second ago. So, the change in production, the change in exports account for more than the total change in stocks, as we have indeed seen a bit of an uptick in crush, as you would expect to see, given lower soybean prices in this country because of the Chinese tariffs. Okay. So I'm going to talk to you now about our preliminary baseline we prepared back in November. It was a snapshot of the market situation based on information that was available on November 12th of 2018. It's not a forecast in the sense of a prediction of what will happen. One reason is that when we put that baseline together, we were assuming then current policies remain in place. That meant we were still using 2014 Farm Bill provisions, as the Farm Bill had not been passed at that time yet. And of course, we also assumed that tariffs in China and other countries would remain in place for the indefinite future. We're not predicting that's what's going to happen. Obviously, the 2014 Farm Bill has now been superseded. I do think that the new Farm Bill probably doesn't have a big impact on market prices for most commodities. There might be a minor exception or two, but I don't think switching from the 2014 bill to the 2018 bill will necessarily change our expected price of corn or soybeans very much. The tariffs in China, on the other hand, that's a really big deal. So if we thought we might have a trade resolution, we could have a much more optimistic picture I'm going to talk about here in the next few minutes. We were starting from USDA's November estimates of crop production, which did not change in the month of December. We took our preliminary numbers, took them to a workshop in December in DC, and had a bunch of people tell us all the reasons we were wrong. why we might have missed this or that other thing. We're going to resume our work on our baseline next week, incorporating those comments. Normally, we would have at our disposal, of course, the new USDA reports that I've talked about previously. We don't have those this year. We've, in fact, put off doing our new baseline for a couple of weeks, waiting for the possibility that the government might reopen. We might be able to take advantage of that information we don't have, and so we're going to be forced to proceed without that very valuable information. So back at that time, here's the crop prices we were projecting for the 2018-19 marketing year and for 2019-20. So the first column gives the actual estimates for the 2017-18 years reported by USDA. The second column there gives you the 2018-19 numbers from USDA as of November, which did not change in December for the major crops, if I recall correctly. And then you see our 2018-19 projection, 2019-20. So in the case of corn, in the case of wheat, we were extremely close to the midpoint of USDA's price range for the current marketing year. USDA was at 360, we were at 359 in the case of corn. USDA was at a midpoint of 510. We were at 512 for wheat at that time. Cotton likewise 73.5 cents per pound for cotton. Midpoint of USDA was 74 cents. We were a bit on the low side of the price range for rice and a little bit on the lower side of the price range for soybeans. Planted area, so we'll come back to soybeans here in a second. Planted area side, again, based on what we knew back in November, we were projecting an increase in corn acreage of about 2 million acres in 2019. A drop in soybean acres of over 4 million acres, a slight uptick in wheat acreage, a slight drop in upland cotton acreage, and very little change in other crops that we keep track of. When you add 13 major crops together, it came back to about the same acreage in 2019 that we were projecting as actually occurred in 2017. 2018 was abnormally high, in part because we had relatively good planting weather across most of the country in 2018. So almost everybody who wanted to plant something was able to do so in 2018, even though weather conditions meant some parts of the country weren't able to harvest everything that was planted. We go back to more normal weather, we have a bit less total acreage. Based on the comments we got a review session, I don't know if we change our stories too much in terms of directions on the basic commodities, with maybe the exception of cotton we'll talk about in a little bit. But I think most people do still expect corn acres to be up in 2019. Most people expect soybean acres to be off by quite a bit. Wheat, I wish we had that winter wheat seedings report so we know just what happened with winter wheat seedings. Regardless of what happened to winter wheat seedings, we might expect a slight uptick in spring wheat planting this spring unless there's something that causes it to be tough for farmers to get in the field. So on the soybean prices, again, if we take that November set of estimates here, the blue line is going to be what those projections were from November. It's at $8.40 price I talked about for 2018-19, and a price in the high $8 range. It's a bit below $9 a bushel for the subsequent 4 years. We'll look at futures prices where they were a couple of days ago for the November futures contract. You see that's consistently running in the high $9 range for the 2019, 2020, 21, and 22 contracts for the month of November. There's always a basis between the futures price and the farm price. So that would absorb part of the gap you see there in those prices. But even when you correct for that, you probably find that the futures price implies a higher marketing year average farm price than we projected back in November. So why is that? Why are futures higher than we are? So one option, of course, is that we're wrong or somebody's wrong, that we just aren't looking at the markets correctly. But I'd argue that probably more important is that we have different assumptions. When we put that baseline together back in November, we were, again, taking current policy. And we meant, current policy to us meant that we would keep the current tariffs that China is imposing on U.S. soybeans in place forever. And there would be no other, no deal reached that would address that situation. My opinion is that the market appears to be assigning some probability that the trade dispute will be resolved, that we will indeed see those tariffs go away and China become a much more important market for our soybeans at some point in the future. In fact, I'd argue that a lot of the day-to-day movement we have in the soybean market these days is because people's guesstimates about what the probability is that we're going to get a trade dispute resolution changes from day to day. When people are optimistic about a resolution, prices go up. When people are pessimistic about a resolution, prices go down. So again, where we end up will depend on what the final resolution is or is not on those disputes we have with China and other countries. So focusing on soybeans. So again, I'm taking in this chart what USDA said in the first column there for 2017-18 marketing year, 2018-19 marketing year, and then our projections for 2018 and 2019 marketing years there in the red on the right two columns. So you can see we very deliberately took as given USDA's numbers on the production side of things for the 2018 year. So took that 4.6 billion bushel crop estimate that was available in December as being correct, even though we know it may well be revised when we finally get the official crop production numbers for the year. We came in just a little bit above USDA's number for crush, a little bit above USDA's number for exports as well. And a lower price. So that may sound backwards, I'm sure, to a lot of people. We have higher domestic use and higher exports, both, yet we're showing a lower price. This all comes back to this trade issue that we talked about before. You know, my opinion is that if the market became convinced that we really weren't going to get a trade resolution anytime soon, it'd be really hard to justify carrying 955 million bushels of soybeans over to the next market. I mean, why would people want to store almost 1 billion bushels of soybeans in the next year if prices aren't going to improve? And so if we really came to believe that things weren't going to get better, you know, we probably have lower prices than we have today and less willingness to store those stocks. And so that's what we're reflecting in our baseline, assuming current policy. 2019-20, we talked about the acreage figure already. Of course, who knows what yields will be in 2019. We just build in here what we consider a trend yield. I will tell you, most people in the marketplace think our yields are too low for 2019. They would probably put in a yield closer to 50 bushels an acre or even higher than that in some cases, as arguing that, you know, changes we've seen in technology, et cetera, means that just a pure straight line trend is probably too low right now. And we're going to think about that a bit before we redo our baseline next week, I'll tell you right now. But even with that relatively low yield number, and even with a sharp drop in planted acreage, and even therefore with a significant drop in production, note that we're talking about still having a large carryout available at the end of the 2019-20 marking year. You know, even if we build in a bit further increase in crush, a bit further increase in exports, we're still talking about over 700 million bushels of carryout on September 1 of 2020. That's a lot of beans, more than we've had any year except the current year, I think forever, if I'm not mistaken. So even getting your prices as high as 884 bushel may be a challenge, given that those fundamentals we just talked about. Switching over to corn now. Same type of, you know, I'll tell the story the same way. So here's the blue line is going to be our November projections. The red line is going to be the December futures contracts that were available earlier this week. So December 2019, December 20, December 21, December 22 futures. Same basic story where the gap between futures and farm prices is almost always positive. And in fact, the 2019 numbers are probably very similar once you correct for the normal base between futures and farm prices. I will say from 2020 on, you know, those lightly traded futures contracts for the very distant future do suggest a little more optimism than we had in our November numbers. But again, a pretty similar story, you know, prices around $4 a bushel or less for corn for the next several years being the most likely outcome. Just one aside quickly here is going to be on Chinese corn data changed dramatically between October and November. China put out some new estimates of how large their production had been going back a number of years. And that caused USDA and others to have to reassess what they had built in for their own supply and demand tables for corn for China. So production estimates for the 2017 marketing year were much, much higher in the new numbers than they were previously, based on the Chinese reports. And because of this going back a number of years, even though USDA revised upward their estimates of domestic use in China, they left some of that in stocks as well. And so the stock levels that were expected to be carrying out the 2017-18 marketing year were, you know, almost triple what they had been estimated to be previously. So what does that really mean in practice? Well, you know, here's a chart showing some of the same information going back a few years with the new numbers now. Green line is going to be on the top is going to be production. The red line is going to be domestic use of corn in China. And then the next one down is going to be the one with the triangles. There is going to be the ending stocks of corn. See how large, they're almost as large as use by the time we got the 2015 marketing year. And while those stocks have turned down a little bit now, they still remain incredibly high by almost anybody's standards. We don't know what Chinese stocks are. It's a state secret in China. Even if the Chinese knew themselves, they wouldn't tell us. You know, and so just how tight those stocks really are matters tremendously. You can see imports by China of corn have been very, very, very small relative to supply and demand. Given the levels of stocks that they are now estimated to have, it seems unlikely to us that China is going to become a major corn importer anytime soon. Again, they could just draw down stocks for quite some time to meet any shortfall in domestic supply and demand that they might have. And if you think about it in a global standpoint, the red line is going to be Chinese stocks of corn, accounting for more than half of global stocks today. If we kind of put those to the side, saying, well, that's kind of isolated from the rest of the world market, who really cares how many stocks the Chinese themselves are holding if it's not going to affect their trade, and focus on the rest of the world, you see that we have got a more optimistic story here. U.S. stocks of corn have been decreasing the last couple of years in 2017 and again in the current marketing year. And we think that the non-Chinese stocks from other countries likewise have been declining the last couple of years. So it is easier to tell a story in the case of corn than the case of soybeans. Suppose we were to have a weather problem in 2019 that caused our corn yields to come in lower than anticipated. We could well see there in response to that a significantly higher price than we have today. So I could easily tell you a story where corn prices being a lot higher than the $4 a bushel I talked about before as being kind of an upside midpoint. But likewise, those stocks are still large enough that if we were to have a trend or above trend yield, we could keep prices below $4 a bushel for some time. So here's the full S&U for corn, following the same pattern we showed you there before for soybeans. Again, taking USDA's figures as given for the 2018 crop, even though we know that's probably not where we'll end up. Taking is given, roughly is given the estimate by USDA for feed use in the 2018-19 marketing year, recognizing that when we get the stocks report for December 1, that may change our mind about what I think actual usage has been there in the current marketing year. It does label as feed use here, but it's actually feed and residual, so any mistakes that USDA makes in estimating supply and demand are reflected in that feed and residual number. See the rest of the figures there for 2018-19, very close to USDA's numbers. For 2019-20, given a little bit more acreage, a little bit lower yield, when we can snap back to a trend yield again, is about the same level of crop production in 2019 as in 2018 for corn. The rest of S&U not changing all that terribly much except for lower exports. We get a little bit higher price and a little bit lower stocks. The export figure is projected to be off in 2019 because we were boosted up in 2017 and 2018 exports by a very small South American crop harvest in the first months of 2018, which affected therefore both the 2017-18 marketing year for us and the 2018-19 marketing year for us. Assuming more normal crop in South America to be harvested in the months to come here, that probably means more competition and tough for us to maintain exports at the kind of level we saw the last couple of years. In the case of wheat, real briefly, again, we have seen some bounce back in wheat prices from the very extraordinarily low prices of 2016-17. We're very close to USDA's estimate for the current marketing year. Futures prices are a little stronger than our projections for the 2020 and 21 marketing years, but for 2019, the July futures contract and our projected farm price are very consistent with each other. Case of wheat stocks, again, sort of like we talked in the case of corn, once again, China has a lot of stocks, so it can be a mistake to focus only on the global number. If you look instead at the non-Chinese, non-US stocks on the green line there, you can see that those stocks are actually down quite a bit this year in 2018-19, in part because of reduced crops in the European Union and Russia that have reduced export availabilities from those countries and therefore have helped us bring down stock levels at least a little bit globally, making things a bit tighter than they were previously. Here's our supply and use for wheat. Again, for 2018, very close to USDA's figures kind of across the board there. For 2019-20, very little change. A slight uptick in area, marginally lower yields, so therefore production's up only a small amount. Maybe a bit higher feed use with higher corn prices. Not much change on the food side, maybe a bit lower exports as we probably had a little bit higher exports this current marketing year because of the problems in Europe and Russia. And so stock levels end up coming down just a very small amount in 2019-20. Prices about the same as they are for the current marketing year. The case of cotton, here's one where there are bigger differences. We had a more spirited discussion about cotton at our review session. We were maybe more pessimistic than a lot of people on the cotton side. We had cotton prices dropping back down to around 67 cents per pound for the 2019 crop year and kind of sticking around that level as far as the eye could see. Even though futures are off quite a bit from their high that we saw earlier, they are still suggesting, even after normal basis are considered, a price a bit higher than we were projecting back in November. And if I were speculating today, I would suspect that when we do our new numbers starting next week, we'll probably be somewhere between the blue line and the red line, if you will, in terms of our projections for the cotton market in the years ahead. A bit stronger than we said back in November, maybe a little bit lower than the futures price that was in the market yesterday. When we do a seed cotton price calculation, the seed cotton price is the one that drives price loss coverage payments. You can see that the new reference price of 36.7 cents for seed cotton effective with the 2018 crop, but we're almost certainly going to have a seed cotton price below that level for the 2018-19 marketing year, so therefore PLC payments will occur for those people who sign up for PLC under the new program. And that given our projections that we'd had the price quite a bit below that for the subsequent years, so there have been relatively large PLC payments for every year from 2019 forward. Now, again, if we were a bit too pessimistic on either cotton fiber prices or on cotton seed prices, then perhaps the blue line shifts up a little bit. But I do expect that the most likely outcome is that there'll be PLC payments every year for the next several years, unless there's a market disruption that causes a spike up in prices. Here's our upland cotton supply and demand table. There was a slight revision upward in the cotton yield by USDA in the month of December. So that's why the 844 there shown for USDA in 2018 is a bit higher than our 836. But the picture is about the same. Again, we have 73.5 cent price projected for 2018-19, very close to USDA's 74 cents in their December estimates. For 2019, we have been projecting a bit of a decline in planted acreage for cotton. I'm less certain about that today. I'm not quite sure what I want to think about cotton acreage for 2019 at the moment, to be honest. I've seen conflicting reports. Earlier, there was, when prices were a bit higher, there was a lot of folks expecting an uptick in cotton acreage in 2019. Again, we'll have to think about that one more carefully here before we proceed with our new baseline next week. Again, what we had back in November, we had a bit of an increase in overall production. So that increase in production, even with a slight uptick in exports expected for 2019-20, is why we were expecting at that time a lower price for the 2019-20 marketing year. As you can see, we were projecting stocks of cotton getting back over 5 million bales again. So that's obviously very important. And if that were to come to bear, then that kind of a price doesn't seem so crazy to me. But again, whether we'll really have that level of production, the level of exports is really the key. Switching now to rice is our final commodity we'll talk about today. A $14 reference price per long grain rice. And these are long grain rice and chart, not all rice. So we were very close to USDA's midpoint for long grain prices, at least for the 2018-19 marketing year. And it turns out also the March futures prices are pretty much on top of where our price projections were for both the current marketing year and for the 2019-20 marketing year as well. So for better or for worse, there appears to be at least some agreement there that rice prices are expected to remain lower than they were in 2017-18, and also well below the $14 reference price for the next several years. Our rice supply and demand tables, again, taking the 2018 figures from USDA largely as given on the supply side in particular, even on demand as well, we're almost on top of USDA's figures. We were a little bit lower than USDA's price for all rice, partly because there's a little bit different story on the California prices. But the long grain rice price is very close to USDA. For 2019-20, we were anticipating at least a small decline in planted acreage. We had built in a significant increase in yields, thinking that the trend yield is a bit higher than we've actually observed the last few years. We had some comments back that maybe we're a little bit too high in our rice yield projections, so we'll look at that one carefully as well as we put together new numbers next week. But the combination shown there would give us a little bit drop in production relative to 2018-19 as the acreage effect more than outweighs the yield effect. With a significant increase in exports projected in our November numbers, that left our stock figures just down ever so slightly from 2018-19, and so prices were expected to increase a little bit from the 2018-19 average, but still around $12 a hundredweight. So summary points, finally, shutdown means that less information is available in the market, adding to the uncertainty we would always have in the market, making our life difficult here at FAPRI as well. The new Farm Bill is evolutionary, not revolutionary. We've made some changes, but for the most part, we don't expect them to affect supply and demand for major commodities very much, nor do we expect them to affect the payments that the typical farmer receives from government programs in the future. The large crop in China's tariffs have pressured soybean prices. I think the market has built in at least some probability of a resolution of the trade disputes. U.S. and non-Chinese global supplies of corn are tighter than for the case of soybeans. So corn prices may be a bit more sensitive to market news than our soybean prices. But in contrast, soybean prices are more sensitive to trade news So again, those two things offset, so we have uncertainty in both of those markets. Then finally, the PLC will continue to be important for rice and cotton producers in particular, and perhaps for producers of wheat, corn, and other crops as well. So thank you very much for the opportunity today. Very much appreciated. There's a very old picture of our gang here at FAPRI. I have to confess that the people in that photo, several people have gone on to other things at this point in life. But we're very proud to have the group we work with here, and looking forward to continuing to work together for quite some time, trying to make sense of markets and make sense of policies for the public and, of course, for folks in Congress and elsewhere who make decisions. Thank you all very much.